Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Thursday. It is the 8th of April. Where is this year going? I don't know, but it's the second trading week of April. It's a Thursday, and we've got a big Fed report today. We've got jobless claims. They come out in about 19 minutes or so, give or take a minute. We're finally getting towards the low 700,000 claims weekly. Now, this is really important because this is a weekly data, and it's very timely. And because it's very timely, it's giving us unemployment numbers almost in real time. Not in real time, but look, take a look. This is from the week ending 4/3, which is last Friday. So it's literally just a few days away. Now, it looks like every time we go into the low 700s or upper 600s, we just come right back up. And it's like teasing us. But the 4-week moving average is getting lower. We're now in the low 700,000s. And the hope is we're going to hit 680 and we're going to stay in that level. We're going to finally break 700 and not go back to 750 or 800 or 900. If the number is bad, if it's like 780, 800,000, it may impact the stock market because we're putting a lot of faith into employment numbers getting better, which is the biggest indicator that America's bouncing back. So if people are not, or if people are filing unemployment benefits or jobless claims, it's not that great of a sign. So again, any number below 700, even if it's like 705, 710, pretty much anything below the 4-week moving average is good, but I would love to see it below 700. It was below 700, and then it went up against 61,000. It was like 660 or 680. And I'm hoping, fingers, toes crossed, that it's 680, 650. Consensus range is fine. I'm good with the consensus range. Low 700s, high 600s, I'll take that. Let's talk about a couple of things. Again, correlation between the Nasdaq. The Nasdaq is higher. TLT is a little bit higher. It looks like the correlation between the bond market and the rest of the stock market, especially the Nasdaq, is cooling off. It looks like bonds, I mean, look at this down move. This is when interest rates went from lower than 1% to about 1.73, 1.75. Remember, there's an inverse relationship between the bond market and interest rates. So as bonds go down, interest rates go up. I think we're going to be in a choppy phase. I think we're going to be in a sideways phase for a while, much of what we saw around here. Remember, markets go vertically, horizontally, and right now we're in a horizontal stage, and we may be there for a while because the last vertical stage was quite lengthy, as you could see here. It was quite pronounced. And bonds are not a very trendy market historically, just so you know. They're not. They're more like a stocks. They're counter-trending market. They're not like currencies and commodities, which tend to really trend, and I mean really trend. Let's talk about, but there is less correlation between U.S. stocks and the bond market. A couple of weeks ago or a month, they were just locked in, especially the Nasdaq and the TLT. But let's talk about global economy, and then I'll talk about U.S. stocks and give you an update. So let's talk about Japan. I was explaining that Japan, I was actually talking about a trade yesterday of shorting Japan and going long U.S. stocks because Japan's numbers, their spending numbers and their employment numbers are just not that great. They're just not really doing that great. They were down like 6.5%, while U.S. was down 1%, and that was because of the weather. But Tokyo's benchmark declined as reports of rising COVID-19 cases alarmed over another setback in the recovery. And it's happening in a lot of places around the world. Many countries grapple with the resurgence of COVID cases and hospitalizations as new infections appear to be outpacing inoculations in many places, and that's the big problem. Fortunately, we're not seeing that in the U.S. right now. Biden is being very aggressive about this. Whether you like him or not, he's being very proactive with this COVID business. Tokyo, just yesterday we were talking about Japan and Japan's market and that linked trade. Tokyo reported 545 new cases Thursday, the highest since February. And its governor asked the central government to let her issue binding orders under a new virus prevention law that includes penalties for business owners who defy measures and compensations for those who comply. Doesn't it sound like March of last year? This is what I was afraid of happening in the U.S. Thank God it didn't. Osaka in Western Japan declared a medical emergency, sad, as its hospitals became inundated with new cases. This is happening, not to this extent, but I know that I was just talking to one of our partners in Canada, and things are getting really bad over there too. Not this bad, but they're going through another lockdown. New cases in India hit a record on Thursday with 126,789. Wow. As Prime Minister got his second shot. Well, that's great. And urged others to follow suit, saying vaccinations is among the few ways we have to defeat this virus. Well, I think it's really the only way. Investors are showing caution. We're now back to the U.S. markets. Investors are showing cautious optimism about the economy recovery, especially in the U.S., where the vaccine distribution has been ramping up. It's been ramping up like crazy, actually. Biden has bumped up his deadline for states to make doses available to all adults by April 19th, which is only 10 days away from now. And I know around here in Florida, most people have been vaccinated. Analysts expect the economy to recover this year, but they anticipate the market to remain choppy. Oh yeah, as investors shift money to companies and industries that stand to benefit as the pandemic eases. Industrial, basic material, financial. Boy, we've been talking about it nonstop. A proposal to invest heavily in major infrastructure, from roads to ports to broadband education and training, could hasten that rebound. That's right. There's going to be a lot of rotation. The minutes from the Fed's last FOMC meeting revealed that Fed officials were encouraged by last month's evidence that the U.S. economy was picking up. I was also encouraged. The numbers were looking better, but they showed no signs of moving closer to ending their bond purchase or lifting their benchmark short-term interest rates from nearly zero. That's what I mean. I think the bonds are going to be kind of choppy. Yield on 10 years at 1.65, and I think we're going to move between like 1.4 and 1.8 for the foreseeable future, and give the stock market a chance to come back a bit. If you look at the stock market, this is the Nasdaq 100, and as you can see here, we have been diverging, and it finally is looking better, but because we're a little cooler on the Nasdaq, but again, we're overbought right now, and I don't know about this Nasdaq, because let me show you. Chart-wise, it looks really bullish, right? Looks like we're coming back up. We're above the 50-day moving average. But again, if you look at momentum levels, I mean, look at this, folks. This is amazing. 85% of stocks are trading above the 200-day moving average. I mean, this is insanity. I mean, this is really big divergence, and it looks like we're going to cool off. So don't expect the QQQ to just keep going higher. It doesn't have that much elasticity in it right now because of the momentum levels. And if you look at the SPY, let me put a normal chart of a SPY. You will see that it's showing a major divergence here. Up on price, high all-time highs, but momentum levels can't go higher. We've seen this story, we've seen the song and dance. And again, momentum levels on the SPY are just unheard of. When you look at them, you will see that 94% of stocks are trading above the 200-day moving average. 87% of stocks are trading above the 50-day moving average. This is a 20-year high. So momentum levels are in nosebleed territories, and I'm expecting potential downside or some pressure. And that's why right now, if you look at the 10 major sectors, notice energy's number 1, financials number 2, industrials number 3, technology is coming back, but not that fast. And if you look at it on a 1-month basis, you will see that consumer discretionary is coming back, but utilities is here. So you have defensive sectors and you have offensive sectors. So I would be very cautious right now because the markets are increasingly fragmented. Now, I like the financial sector. I'm not so sure about the energy sector because it is moving higher, but it's not the broad index is not above last February's high. But I do like the financial, I do like the industrial sector right now quite a bit. So if you look at the financials, you will see that they are coming back, and they're coming back pretty hard, and they're not overbought. And a matter of fact, if you add a drawing study to this, you will see that we are actually setting up for an ascending triangle, which is a bullish pattern. I would ignore this top here. It's not really that meaningful, but even if you go higher, it's still an ascending triangle, any way you look at it. Ascending triangles typically break out to the upside, and if any sector is going to go higher, it would be the financial sector because it's getting so much stimulus aid and interest rates are near historic lows. So some of financial stocks, not like savings and loans, but investment banks, a lot of financial stocks, a lot of them are moving higher because there is a potential or a fear of higher interest rates. People are refinancing their homes, but economy is picking up. So I like the financial sector, and the two stocks that I like in the financial sector, one of them is US Bancorp. It's rated at a strong buy right now. And you will see here it's also moving higher, but not parabolically. It's moving higher at a steady pace, meaning volatility is still low, and it can give us a nice breakout. So I do like this. I think it can rally up to the $60, $62 range over the near term. When I mean near term, I'm talking about over the next 6 weeks or so. I like this. I like this trend line here. It looks, looks pretty good. Let me just draw this so I could pretend to be Picasso. But I like this ascending triangle. It looks like it's going to break out. US Bancorp, one of the better run banks, a lot better run than Wells Fargo. I'm not a big fan of Wells Fargo, but I like USB and Ally Financial. This is one that Jack Carter has been talking about, and I couldn't agree with him more. Look at this trend here. It looks like it's about to break out. And again, if you look at this chart over time, let me just draw a little trend line here. You will see that it's actually doing really, really well. Look at this. I can eventually become a good trend line drawer. Again, ascending triangle, ascending triangle, ascending triangle. They're not perfect ascending triangles, but they're looking really, really good. And I think Ali's going to hit the 52, 53 level after it breaks out one more time. But I do like the financials right now a lot more than I like technology. A lot more than I like technology. I like basic material, I like financial, I like industrial a lot, some consumer discretionary, and I like basic materials. Otherwise, I would be very, very, very cautious. Consumer discretionary, you got to be very, very cautious right now. If it's not too tech related, then it's probably a good bet. If it's really tech related, right now you got to be very, very cautious because tech is a bit overbought right now, and it has the biggest sensitivity to interest rates, and eventually, not now, but by the end of this year, there's a good chance long-term rates could be above 2%. We're now at like 1.65. There's a good chance. So earnings on tech have to overcome that, and that's what we're waiting for right now. So we got to be very, very cautious. But I like XLF, that's an ETF. I like USB, and I like Ally Financial. Now, before I let you go, I've got something important for you, crucial, timely, something that could potentially make you big bucks. Wall Street legend Chuck Hughes, he's already helped traders around the globe reach their dreams. Actually, for years he's been doing this. Some of his clients have been with him for 15 years, 14 years, 8 years, 9 years. I mean, he keeps his guys around for a long time. But now he's revealing his most shocking discovery yet, and it's shocking. Chuck's discovered a brand new strategy to target weekly profit opportunities. Man, there's nothing better than weekly profit opportunities, regardless if the stock market is going up, down, or sideways. I love this. In fact, the formula has helped him lock in a 96.3% win rate, even when markets are turbulent. Remember, it works when markets go up, down, or trade sideways. And now, he's about to share it with the rest of the world for the first time ever. You've got to check this out. 96.3% win rate. Making money on the way down, up, or sideways. Weekly opportunities, weekly profit opportunities, regardless if the market is up, down, or flat. Click on the link below. Check it out now. Access this formula right now. Don't wait another minute. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. And stay ahead of the market, folks. Stay ahead of the market by being the first to be notified when we post new videos. And have an amazing day. The weekend is coming up. Stay out of trouble. Bye.